Hi guys. Today we will analyze Under Armour stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. The short-term trend is very negative, while the long-term trend is still neutral. It is advised to wait a little bit longer to see how this turns out. Strong support level is around $9. Next strong support level is around $8. Strong resistance levels are around $11.50 and $14. Next strong resistance levels are around $17, $20 and $22. In the last month the stock has been trading between $9 and $11.50 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 8 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a strong downward trend since November 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around -1% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 157% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Under Armour Company: bad, average, and good. First scenario. Under Armour will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low 2%. Future profit margin would be a low 2%. Future free cash flow to net income rate would be a low 80%. In this case, the fair value of the stock today would be $4. Second scenario. Under Armour will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average 4%. Future profit margin would be average 3%. Future free cash flow to net income rate would be average 90%. In this case, the fair value of the stock today would be $6. Third scenario. Under Armour will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high 6%. Future profit margin would be high 4%. Future free cash flow to net income rate would be high 100%. In this case, the fair value of the stock today would be $10. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 0.47. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Under Armour, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Under Armour Company: bad, average, and good. First scenario. Under Armour will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low 2%. Future P/E would be a low 13. In this case, the fair value of the stock today would be $3. Second scenario. Under Armour will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 15. In this case, the fair value of the stock today would be $4. Third scenario. Under Armour will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 17. In this case, the fair value of the stock today would be $6. As you can see, today the stock is overvalued, $10, even if we expect the company's high performance in future. While the company has a good financial health rating, there are some concerns on its profitability. While showing a small growth rate, the stock looks a bit overvalued at the moment. Also, the stock has been in a strong downward trend since November 2021, and it can go lower before it recovers. The stock has a very bearish sentiment score, so the price may be very volatile in the next 1-2 years. The stock would be an interesting play if it drops to $8. Do your due diligence before buying the stock. Keep in mind that there are two Under Armour stocks, Under Armour Class A, ticker UAA. It traded at $10.50 today, it gives you voting rights. And, Under Armour Class C, ticker UA. It traded at $9.70 today, it doesn't give you voting rights. It's up to you which one to buy, it doesn't really matter. Class C is usually 80 cents cheaper than Class A. Company strengths. Under Armour is an American sports equipment company that manufactures footwear, sports and casual apparel. Its products have become popular with competitive athletes and consumers with active lifestyles, and are sold in more than 25,000 retail outlets worldwide. So-called technical apparel, that is highly breathable or that offers warmth without excessive bulk, is becoming more mainstream. This will be positive for Under Armour, as more consumers recognize the benefits of the company's products. Under Armour could gain shelf space and distribution, as Nike has reduced or eliminated shipments to some major sportswear retailers. The company has improved results by closely managing inventory, avoiding product discounting, focusing on premium products, and boosting direct-to-consumer sales. It has also strengthened marketing, and implemented a restructuring program to lower costs. Also, the company has significantly reduced its long-term debt. Risks. Like most retailers, the company is facing pressure from supply chain disruptions and higher freight costs. The pandemic has interrupted Under Armour's turnaround and expansion in China. The company is in a highly competitive business, whose products are often discretionary purchases. As such, sales are likely to suffer in an economic downturn. Under Armour is exposed to struggling physical retail through its sizable U.S. wholesale business. Many stores may close, including some that carry Under Armour. Closings may hurt sales, and lead to widespread discounting. The company's return on assets of 5%, return on equity of 13% and profit margin of 4% are worse than the rest of the industry. The revenue is expected to grow only by 4 to 6% on average over the next 5 years. The earnings per share is expected to grow by 6 to 8% on average over the next 5 years. If you are a shareholder, and the company decides to issue more shares, your slice of the pie in that company decreases, because there are more slices out there now. Company may issue more shares if they are looking to finance a new project, or if they are looking to have significant compensation for its staff through stock options. As you can see, Under Armour shareholders have been diluted in the past 11 years, 1 to 4% yearly. It's not good. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.